Every trading day, billions of dollars seem to disappear at exactly 4 p.m. Not stolen, not transferred into some secret Wall Street account, and not actually destroyed. But if you've ever watched a stock chart at the end of the trading day, you've probably seen something strange. The price suddenly jumps, volume explodes, orders pile up, and then, at exactly 4 p.m. Eastern Time, everything stops. So what is actually happening? Where does all that money go? And why does Wall Street treat the final few minutes of the trading day so differently from the other 6.5 hours? The answer is hidden inside something most retail traders rarely think about: the closing auction. 4 p.m. isn't just the market closing. Most people imagine the stock market like a store. It opens at 9:30. People buy and sell. Then at 4 p.m., the doors close. But that's not really what happens. The final moments of the trading day are an important price discovery event. At the NYSE, the core trading session runs from 9:30 a.m. to 4 p.m. Eastern Time, with a closing imbalance period beginning at 3:50 p.m. and the closing auction taking place at 4 p.m. And that final auction can involve an enormous amount of buying and selling interest. The NYSE says the closing auction has grown to more than 10% of NYSE listed volume and is the exchange's largest single daily liquidity event. So 4 p.m. isn't simply a moment when traders stop. It's a moment when a huge amount of trading interest is brought together. Imagine a giant final marketplace. Suppose thousands of investors want to buy a particular stock at the end of the day. At the same time, thousands of others want to sell. Instead of matching every order independently at slightly different prices, the closing auction attempts to find a single price where the largest possible amount of eligible buying and selling can meet. That's the basic idea. Imagine 1 million shares want to buy, 900,000 shares want to sell. The auction searches for a price that allows as much of that interest as possible to trade. The result becomes the official closing price. On NASDAQ, the closing cross is specifically designed to execute eligible orders at a single price and establish the official closing price for NASDAQ-listed stocks. And that's where the mystery begins. The price you see at 4 p.m. isn't just the last trade. During the normal trading session, prices continuously change as orders meet. But the official closing price can be determined through the closing auction. That means the closing price isn't simply whatever the last person paid. It's the result of a structured process designed to bring together substantial buying and selling interest. And that's why you sometimes see a stock trading at $100 at 3:59 p.m. and then its official close appears at $100.42. It doesn't mean 42 cents suddenly appeared out of nowhere. It means the closing auction discovered a different price at which the eligible orders could be matched. Then there's the 3:50 p.m. explosion. Here's something most retail traders don't notice. The important period begins before 4 p.m. At the NYSE, 3:50 p.m. is a major cutoff for market on close and limit on close orders. Beginning around that time, the exchange starts disseminating information about the closing imbalance, with updates continuing toward the auction. An imbalance basically means there is more eligible buying interest than selling interest, or more selling interest than buying interest at the relevant reference price. Imagine the market suddenly reports, buy imbalance, 2 million shares. That's information. Other traders now know that there is significant demand that needs to be matched. They can potentially submit offsetting orders. The imbalance can change. The indicative price can change, and suddenly, the final 10 minutes become extremely interesting. What is a market on close order? This is one of the most important pieces of the puzzle. A market on close, or MOC order, tells the market, execute me in the closing auction at the closing price. You aren't specifying an exact price. You're prioritizing participation in the closing process. A limit on close, or LOC order, adds a price limit. It essentially says, participate in the closing auction, but don't execute beyond my specified price. These order types allow institutions and other participants to express very specific intentions about the market close, and because huge institutions use them, the closing auction can contain enormous amounts of liquidity. So where does the money go? Now we can answer the title. When billions of dollars are traded at the close, the money isn't disappearing, it's changing hands. A buyer sends money, a seller gives up shares, another investor receives the money. The shares move to a new owner. What looks like money disappearing from one account is actually part of a massive transfer between buyers, sellers, brokers, clearing systems, and other market participants. And sometimes the apparent loss is simply a change in the market value of an asset. If you own 1,000 shares and the closing price falls from $100 to $98, your position is now worth $2,000 less. But nobody necessarily received your $2,000. The market value simply changed. That's an important distinction. Why does the closing price matter so much? Because the closing price isn't just a number on a chart. It's used throughout the financial system. Portfolio managers use closing prices to value holdings. Indexes use them. Performance calculations use them. Mutual funds and other investment products rely heavily on end-of-day valuations. And huge institutional portfolios may be measured against benchmark prices. So moving the closing price by even a small amount can matter when you're managing billions of dollars. That's why the close attracts so much attention. The index rebalance effect. Now imagine a major index is changing its holdings. A stock is being removed, another is being added. Thousands of funds may need to adjust their portfolios. Instead of making those trades randomly throughout the day, some institutional strategies concentrate activity around the close. The result? A gigantic burst of buying and selling. NYSE research has specifically examined closing auction activity around index rebalancing days, where large orders can create significant auction liquidity. To a retail trader watching the chart, it can look insane. The stock barely moves all afternoon, then suddenly, boom, huge volume, sharp price adjustment, and the market closes. But there's a reason. The financial machinery was waiting for that final auction. Is the closing auction manipulated? This is where we need to be careful. Large orders can influence prices. That's basic market mechanics. But that doesn't automatically mean someone is secretly manipulating the market. The closing auction is specifically designed to incorporate large amounts of buying and selling interest. In fact, exchanges publish imbalance information precisely so participants can see what is happening and respond. The NYSE describes its imbalance feed as including information such as imbalance quantity, paired quantity, and indicative match price. That's not a hidden casino. It's an organized price discovery mechanism. Of course, illegal manipulation can happen in financial markets, but a large price move at the close is not automatically proof of manipulation. Sometimes, it's simply a lot of orders meeting at the same time. So, what should you watch? If you're a retail trader, you don't necessarily need to participate in the closing auction, but understanding it can make the market look much less mysterious. Pay attention to the period leading into the close. Watch for unusual volume. Understand that large institutional orders can create temporary imbalances. And remember that the official closing price can be determined through an auction, rather than simply being the final ordinary trade you happen to see on your chart. Most importantly, don't assume every strange-looking move at 4 p.m. is a conspiracy. Sometimes the explanation is much simpler. A massive number of people needed to trade at the same time. The final question. So where does the money disappear at 4 p.m.? It doesn't. It moves. Shares move from sellers to buyers. Cash moves in the opposite direction. Prices adjust. Portfolios are revalued. And perhaps the strangest part is this. You may spend 6.5 hours watching a stock move, but the price you'll remember for the entire day may be decided in a process that takes place in the final moments. So the next time you see a stock explode in volume at 4 p.m., don't ask, where did all that money go? Ask, who needed to trade and why did they all need to do it at the same time? Because once you understand the closing auction, 4 p.m. doesn't look like the end of the market anymore. It looks like one of the most important moments of the entire day. If this video opened your eyes to what really happens at the market close, hit like, subscribe, and share it with another trader. And tell us in the comments, did you know the 4 p.m. closing price can come from a massive auction rather than simply being the last ordinary trade?